Hello and welcome to this weekly market recap for the week ending Friday, December 5th, 2025. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com. It's a pleasure to be with all of you again this week. Going to be a little bit of an abbreviated recording today. Just wanted to touch on a few things I think important from last week, and then also as we look ahead. Big news last week was the ADP employment report that came out on Wednesday and showed that jobs were negative. We won't get the non-farm payrolls out until the middle of the month. It was delayed as a result of the government shutdown. And the Fed will be coming up this Wednesday to announce what most folks now are expecting is going to be a rate cut, another 25 basis points. So I think the market's kind of got all that factored in. And now it's just a question of where we go down the road, what the Fed's going to do. What are they going to say? There's been a lot of disagreement among the Fed officials. Can't really agree on things. Some more worried about inflation, some more worried about the economy. So, I think everyone's kind of agreed that we're going to get 25 basis points, but will the Fed tap the brakes after this rate cut? Are they going to suggest maybe they're going to pause again for a while until they get more data and things? Who knows? I can say, though, that money has rotated away from growth. Which is never a good thing. I mean, it's okay to rotate for a period of time, let the market kind of catch its breath. But when we start to rebound again, we want to see some of that money rotating back in to some of these aggressive areas. And we haven't really seen that. And I've got a couple charts I'll show you in just a bit. But why don't we go ahead and just take a look at what happened in the market this past week, and we'll go from there. So first, transportation, really solid week for transport. So if you're looking for something that's really bullish, some silver lining in what's been going on, because we've had a little bit of a rough patch over the last month or so, month and a half. This is definitely a silver lining. Transports have really performed well, gaining 3.6% last week. NASDAQ gaining 1%, everything else fractionally higher. So at least we had a really nice week, got a nice rebound, which was good after some of the selling that we saw in November, which normally is one of our best months seasonally. Moving on to the sectors, technology bounced back. That was good. This was one thing that I really wanted to see. I want to see technology bouncing back. It wasn't quite as much of a move to the upside as I would like to have seen, given how much it had deteriorated to the downside during the period of selling in the market. But still, it was back up. It led the action last week. So let's give at least some kudos to the bulls for staging a rally in the technology area. You can see it was a split, bifurcated kind of week, though. The S&P 500 only gaining 0.3%, with 5 sectors underperforming and 6 outperforming. 5 actually in the red, losing 1% or more. The good news is most of those losing, or actually all of those losing, were more defensive and value-oriented sectors in the market. So we did see some of that money rotate back to growth, and that was at least one positive takeaway from last week. We've got other issues, but that was one positive takeaway. Looking at the S&P 500, we're about to break out to another all-time high. We're only 2 percentage points away from reaching 7,000 right now. And that was the target that we gave at the beginning of the year. We already got to 6,900, a little over 6,900 back at the end of October. But we're right back up there. We hit a high of 68.95 on Friday, intraday, but we did see some selling in the afternoon. We ended up coming back down, closing at 68.70. Is this a double top? Because right now we have a double top and we have a double bottom. So clearly off of the uptrend, the S&P 500 is sideways consolidating. Normally, we would see a breakout to the upside. This is a kind of a bullish continuation type pattern. I've got some other issues with the thought of the market breaking out, though. There's some other issues in terms of, us being at the top of the channel, some of the relative ratios, the sustainability ratios that I like to follow, and some other issues that I'll be getting into more when we get to Market Vision 2026, the first Saturday of January. That's where I give my forecast for next year. So definitely some things going on under the surface we'll be needing to talk about. But just on the surface here, looking at the price action, a breakout, a really solid breakout above 6,900 would be confirmation of this continuation pattern and could potentially send us higher in the near term. But does it, is that breakout accompanied by sustainability ratios that are also breaking out, or are those suggesting that maybe the rally isn't sustainable? That's really the big question, or one of the really big questions for me right now. Also looking at the S&P 500 here on this chart, this is where I show those sustainability ratios. So here's the S&P. Down below, look at the QQQ relative to the S&P. So you see how the S&P is all the way back testing the highs? This relative ratio is not. In other words, the NASDAQ on a relative basis from the high at the end of October until the high on Friday, QQQ, the NASDAQ 100, is underperforming the S&P 500. The more growth-oriented stocks over the course of the last 5 weeks have been underperforming as we try to rally back. That can be a problem. Doesn't have to be. It's not a guarantee. It's a potential warning sign. Consumer discretionary versus staples, same thing. We're not back at the high like we are on the S&P 500. So money rotating away from the high growth on a relative basis over the last 5 weeks, money rotating away from the more aggressive discretionary area and into the more defensive staples area. And look at large cap growth versus large cap value here. We've hardly seen any bounce whatsoever. So this rally that we've seen is not being led by the large cap growth names. It's been kind of evenly distributed between large cap growth and large cap value. It's just giving a sign that the market isn't quite as, it's not quite the same risk on environment. And that's what drives bull markets. So it's something to be thinking about, to maybe taking a little pause. We've had a big rally off the April low. I do want to tell Earnings Beats members, in the weekly market report, the weekly portfolio report that will be out at some point later today. We are going to continue tracking our portfolios as we always have. And I'll show you how the stocks within the portfolios are performing week to week. But on the website, we closed out our portfolios as of Monday of last week. And right now, actually, our aggressive portfolio is beating the S&P 500 by about 4 percentage points. So we feel really good about the portfolios and what they've done. And just because of some of the added risk, we just don't want to take much of a chance here. I want to see how this plays out here. I believe, being in the most bullish seasonal period of the year, that we're probably, I would be surprised if we just all of a sudden had a big sell-off. I just don't know how much upside we have, even with the Santa Claus rally coming up later this month. I'm just a little concerned that maybe we get a 1 or 2%, but I don't know if we have a whole lot more upside than that. And to take on the risk of being in the market for 1 or 2 more percent of upside is where, I'm just having a little bit of an issue. But anyway, in the weekly portfolio report, we will keep tracking our portfolios. I just want to let you know. But our performance in the portfolios will be stagnant as of the Monday close from last week. So I just wanted to be clear on that. What else did we have here? So there's the large cap growth. There's another large cap growth versus large cap value ratio. That one's a little bit better than the IWF IWD, but not much. Look at mid cap growth versus mid cap value. Mid cap growth went to a 6-month low, maybe 7-month low, with that selling at the end of October and early, first half of November, or first few weeks of November. And now, as the markets come back up to an all-time high or near an all-time high, mid-cap growth stock still not really bouncing much, not getting much leadership there. So, but small caps certainly have done well. We're right back up. So that's the one ratio that does look pretty good. And I think small caps overall still look good. And small caps, like I've said, love rate cuts. So the fact that we've gone from about a 30% chance of an upcoming rate cut, maybe just 10 days ago, 2 weeks ago, something like that, to now, which is about a 90% chance of a rate cut, we've seen money rotate back into small caps, back into regional banks, back into transports, back into home builders, maybe to a little lesser extent. But some of those interest rate sensitive areas have done really well. Anyhow, I want to keep moving, try and get through just a couple more things here and then wrap this thing up. Over the course of last week, I showed you the sector performance and what was leading, including technology. Here is the leadership in terms of industry groups over the course of last week. So what this tells us is trucking has been the best industry group in the last week. It outperformed the S&P 500 by 9.69%. Now remember, the S&P was already up 0.3%. So that means trucking was up about 10% for the week on an absolute basis. And on a relative basis, it was up about 9.7% more than the S&P 500. And then as you go down the list, I was looking, I'm like, where are semiconductors? That's what's been leading the market to the upside in 2025. Where are they? Oh, you went down. Well, here they are down here. There's semiconductors. Here's software. So we got a couple. There's internet. So we're getting a little bit of outperformance in some of those key areas. But as I looked, I mean, I'm seeing a lot of discretionary. Here's a discretionary group. Autos, by the way, Tesla trying to make a breakout. Keep an eye on Tesla. Travel and tourism, clothing and accessories, footwear. And so I thought, well, let's take a look at what's going on with the XLY. Here's the XLY. We've come back up, gotten very close to that high that we saw back earlier in the fourth quarter. Need to get up to about 122 or so to clear. But I would keep an eye on discretionary, because discretionary had been underperforming the S&P 500 for a while. And with money rotating away from technology, if that continues, discretionary could be a beneficiary. I don't see like an upcoming bear market. I just see a lot of issues that we need to be aware of in terms of, maybe just sideways consolidation, maybe a correction. That wouldn't be a shocker. But in the near term, while the market's still trying to go higher, I think discretionary could be a beneficiary here. So let's keep an eye on that. Just want to mention, if you are new to earningsbeats.com, you can go over to our website, earningsbeats.com, sign up for your free 30-day, no-cost trial, completely free. You do have to provide us a credit card, but we'll let you know before we charge at the end of the 30 days. We'll also give you a great annual offer to try and save you some money if you like the service. But check that out. Check out the service. Going into year end, this is going to be a great time because there are a lot of question marks out there. I'll keep you posted on what I'm seeing on a regular daily basis. We got a lot of stuff that we do at Earnings Beats. I think you'd enjoy it. Give it a shot. If you scroll down, we do have a free Earnings Beats Digest newsletter. Name, email address. Literally, we have tens of thousands of folks that have joined us. Make sure you check that out. I have a really, really interesting chart that I want to share with everybody on Monday. I think market makers are manipulating the heck out of this stock, probably to accumulate for all of their institutional clients. In the meantime, a lot of us retail traders are getting whipsawed in this stock. Anyway, you're going to want to check that out on Monday morning. Go on in, sign up, name, email address, hit that subscribe button. We'll get that chart out to you on Monday. If you like what we do here at Earnings Beats, like the video, please. Subscribe to the channel. We do a lot of events, free live streaming events. If you are subscribed and you have your notifications on, if we go live for a free event, you'll be notified. So make sure you subscribe, turn those notifications on, and enjoy as we have events coming up. All right, that's about it. I just wanted to do a really quick recap what happened this past week, some things to look for as we go forward. Can we make these breakouts? Does money rotate into some of the aggressive areas to support a breakout? That's going to be really important as we move into year end. Have a great rest of your day, everybody. Happy trading, and I'll be back in touch with all the EB members this week. See ya.